Have you ever bought or sold Bitcoin in Australia? If you have, there's something you need to know. The taxman is watching. Many people assume that cryptocurrencies like Bitcoin operate outside the reach of traditional tax systems, but in reality, the Australian Taxation Office, ATO, has strict rules about how Bitcoin is taxed. In today's video, we'll explain how Australian taxes apply to Bitcoin and other cryptocurrencies, and by the end, you'll know exactly what you need to do to stay on the right side of the law. What is Bitcoin and how is it treated for tax purposes? Before diving into how Bitcoin is taxed in Australia, let's quickly explain what Bitcoin is and how the Australian Taxation Office, ATO, treats it for tax purposes. Bitcoin is a form of cryptocurrency, a digital asset that operates independently of a central bank and uses encryption techniques to regulate the generation of units and verify transactions. The ATO treats Bitcoin and other cryptocurrencies as assets rather than currencies. This means that for tax purposes, Bitcoin is treated similarly to investments like shares or property. This distinction is important because it affects how transactions involving Bitcoin are taxed. When you buy, sell, or trade Bitcoin, you may be liable for capital gains tax, CGT, or income tax, depending on how you're using the cryptocurrency. In the ATO's eyes, Bitcoin is not treated as money. Instead, it's classified as property or a capital asset. So any gains you make from buying and selling Bitcoin are subject to the same tax rules as other investments. This is important to keep in mind, especially if you're planning to make a profit from Bitcoin trading or investing. Capital gains tax, CGT, on Bitcoin. One of the most important taxes to understand when it comes to Bitcoin is capital gains tax, CGT. If you buy Bitcoin and later sell it for a profit, you'll need to pay CGT on the gain you made. Capital gains are calculated as the difference between the price you paid for the Bitcoin, the cost base, and the price you sold it for. For example, let's say you bought one Bitcoin for $20,000 and later sold it for $40,000. Your capital gain would be $20,000 and you'd need to pay CGT on that amount. The exact amount of CGT you'll pay depends on your marginal income tax rate, as capital gains are added to your taxable income for the year. The good news is that if you've held the Bitcoin for more than 12 months before selling it, you may be eligible for a 50% CGT discount. This means that instead of paying tax on the entire $20,000 gain, you'd only pay tax on half of that amount, $10,000. This discount is designed to encourage long-term investment rather than short-term trading. It's also important to note that capital losses can be used to offset capital gains. If you sold Bitcoin at a loss, you could use that loss to reduce your overall capital gains for the year. For instance, if you made a $10,000 profit from selling one cryptocurrency, but a $5,000 loss from selling another, you'd only pay CGT on the net gain of $5,000. Capital gains tax applies not just when you sell Bitcoin for Australian dollars, but also when you trade it for other cryptocurrencies, use it to buy goods and services, or gift it to someone else. Each of these actions is considered a CGT event, and you'll need to keep records of your transactions to report them accurately to the ATO. Income tax on Bitcoin. If you're involved in day trading or using Bitcoin as part of a business, you may be subject to income tax rather than capital gains tax. The key difference here is whether you're considered a trader or an investor by the ATO. If you're regularly buying and selling Bitcoin with the intention of making a profit from short-term price movements, the ATO might classify you as a trader. In this case, your Bitcoin transactions are treated as business income, and any profits you make are subject to income tax. Let's say you're a full-time or part-time Bitcoin trader, buying and selling multiple times a day. In this case, all your profits would be considered business income and you'd need to report them on your tax return. Similarly, if you're mining Bitcoin or receiving it as payment for services, those activities would also be subject to income tax. It's crucial to note that if your Bitcoin activities are classified as business income, you won't be eligible for the CGT discount. Instead, all your profits will be taxed at your regular income tax rate. This is an important distinction, especially for people who engage in high-frequency trading or mining operations. GST on Bitcoin. One area that has caused confusion in the past is goods and services tax. GST, on Bitcoin. Fortunately, the rules surrounding GST and Bitcoin were clarified in 2017. Before that, Bitcoin was treated as a commodity, and transactions involving Bitcoin were subject to GST. However, under current rules, Bitcoin is treated as money for GST purposes, which means that you don't need to pay GST when you buy, sell, or trade Bitcoin. For businesses that accept Bitcoin as payment for goods and services, the transaction is treated like any other sale in Australian dollars. The business must charge GST on the goods or services sold, but there's no need to charge GST on the Bitcoin itself. This change has simplified the tax treatment of Bitcoin for businesses, ensuring that they don't face double taxation. However, if you're buying or selling goods with Bitcoin, you still need to account for the capital gains or losses on the Bitcoin used in the transaction, as this would be considered a CGT event. Record keeping and reporting. One of the most important aspects of managing your Bitcoin taxes in Australia is record keeping. The ATO requires that you keep detailed records of all your cryptocurrency transactions, including the date of the transaction, the value of the Bitcoin in Australian dollars at the time of the transaction, the purpose of the transaction, buying, selling, trading, or using Bitcoin, the details of any associated fees or charges. These records are essential when it comes to calculating your capital gains or income tax liability. You'll need to report all your Bitcoin transactions on your annual tax return, and having accurate records will make the process much easier. The ATO has access to data from cryptocurrency exchanges, meaning that it can cross-check your reported transactions with your actual trading activity. If there are discrepancies between what you report and the information the ATO has, you could face penalties or an audit. Tax implications for investors versus traders. As we mentioned earlier, the tax treatment of Bitcoin depends on whether you're considered an investor or a trader by the ATO. Let's break this down a bit further. Investors are individuals who buy Bitcoin as a long-term investment with the intention of holding it until its value increases. For these people, capital gains tax applies when they sell or use their Bitcoin. The 50% CGT discount is available to investors who hold their Bitcoin for more than 12 months before selling. Traders, on the other hand, are individuals who buy and sell Bitcoin frequently with the aim of making short-term profits. For traders, any gains are considered business income and are subject to income tax rather than capital gains tax. The ATO will look at factors such as the volume and frequency of your trades, the purpose of your Bitcoin activities, and whether you're using professional tools or services to determine whether you're a trader or an investor. If you found this video helpful, don't forget to like, share, and subscribe to our channel for more content on cryptocurrency, taxes, and personal finance tips. Let us know in the comments if you have any questions or if there's a specific topic you'd like us to cover next. Thanks for watching, and we'll see you in the next video.